దూరవిద్యా విధానంలో డాక్టర్ బిఆర్ అంబేద్కర్ ఓపెన్ యూనివర్సిటీ దేశంలోనే మొట్టమొదటి సార్వత్రిక విశ్వవిద్యాలయం. దాదాపు 2.5 దశాబ్దాలుగా దూరవిద్యా విధానం ద్వారా కంప్యూటర్ కోర్సును అనుసంధానం చేస్తూ BA, BCom, BSc డిగ్రీ కోర్సులను అందిస్తోంది. పోస్ట్ గ్రాడ్యుయేషన్ స్థాయి, డిగ్రీ, డిప్లొమా స్థాయి కోర్సులను ఔత్సాహికులైన విద్యార్థులకు అందిస్తోంది. డెవలప్మెంట్ స్టడీస్లో సెంటర్ ఫర్ ఎకనామిక్స్ అండ్ సోషల్ స్టడీస్ ద్వారా MPhil, PhDతో పాటు విశ్వవిద్యాలయమే స్వయంగా దూర విద్యా విధాన అంశంపైన PhD వంటి పరిశోధన కోర్సులు ప్రవేశపెట్టింది. రాష్ట్ర వ్యాప్తంగా సుమారు 4.5 లక్షల మంది విద్యార్థులు ఈ విశ్వవిద్యాలయం నుంచి ఉన్నత విద్యావకాశాలు పొందుతున్నారు. డాక్టర్ బిఆర్ అంబేద్కర్ సార్వత్రిక విశ్వవిద్యాలయం స్థానికంగా స్వయం బోధనా పద్ధతిలో ముద్రణ రూపంలో రూపొందించిన కోర్స్ మెటీరియల్ అందిస్తోంది. కోర్స్ మెటీరియల్ అధ్యయనానికి సహకరించే విధంగా రేడియో, టెలివిజన్ పాఠ్యాంశాల ఆధారంగా కార్యక్రమాలు ప్రసారం చేస్తోంది. అధ్యయన కేంద్రాల ద్వారా ఏర్పాటు చేసే సలహా సంసర్గ తరగతులు, సైన్స్ ప్రాక్టికల్ సౌకర్యాలు విద్యార్థులకు స్వయం అధ్యయనానికి ఒక చక్కటి అవకాశం. ఇవి విద్యార్థి సమీపంలో ఉండే అధ్యయన కేంద్రం నుంచే పొందొచ్చు.
Welcome to all the viewers of the teleconference programs of Dr. B.R. Ambedkar Open University on cost of capital and capital design. This program is intended for MBA second year students under financial management. You are aware that every business, irrespective of its size, big or small, requires capital, both to start the business and to run it. Finance is the core, the heart of every business, primarily because it is a scarce resource and because it has a lot of alternative uses. The main objectives of financial management, as you all know, are profit maximization and wealth maximization. And in order to achieve these twin objectives, the financial pattern and the cost of capital play a very significant role. In this connection, I solicit your active participation in these discussions and advise you to seek clarification from the resource persons who are present here. You may allow 30 minutes for subject presentations and thereafter raise your doubts if any. For reaching us, dial 040-270-31431, 270-31432, 270-31433. Before starting the discussions, I take it as my privilege and my honor to introduce to you the eminent resource persons who are amongst us. Left to me is Professor K. Swami, Dean, Faculty of Commerce, Dr. B.R. Ambedkar Open University, a remarkable academician, workaholic, honest and selfless professional as he is. To my extreme left is Dr. R.K. Mishra Garu, Director, IPE, Institute of Public Enterprise, a renowned educationist, global management leader who makes impossibilities possible. Our salutations to our gurus. Now we shall go into the discussions. Swami sir, I would like to know from you, what is capital and why do we need capital?
Capital is the minimum amount of money that is required to start any business. If we wanted to start any business, if we want to take up any undertaking, we need money. We need the initial money. Whatever money you need to set up the business activity is known as capital. So, capital is nothing but the amount of money that is required to invest in any business organization. You may ask me why we need capital. We need capital because of various reasons. Number one is probably you would like to float the company. you need to incur pre-incorporation expenditure. You may need to consult many people, probably a consultant. You may have to approach regulatory bodies. You may have to approach a register of companies. You may have to work out on the project viability, so on and so forth. These are all come under pre-incorporation expenditure. Then probably depending upon the level of activity, you have to plan for fixed assets. What is a fixed asset? Fixed asset is an asset that is useful to the company over a period of long time, probably land, building, plant, machinery, this kind of things. So, you need certain amount to acquire all these things. Thirdly, once you acquire all the fixed assets, whatever I have mentioned, you have to put them into use. For putting all the fixed assets into use, we need working capital, that is nothing but circulating capital. So, we need money to acquire fixed assets, we need money to keep running the fixed assets. That is the basic intention of investing the money in any business organizations.
Thank you, sir. Mishra sir, can you tell us how do the business houses finance their capital needs?
Thank you. So, there are a number of sources, as Professor Swami has just mentioned. We have fixed capital, you have liquid capital or working capital. Now, fixed capital is something which is fixed, as he told, it is required for long term purposes. Therefore, it should be financed and it has to be financed only through sources which are of long term nature. Now, when we talk of such sources, to my mind immediately a source comes, and that is known as equity. Now, equity is the investment which owners or outsiders make in the enterprise through various ways with the intention to take risk. They make it for long term, they do not withdraw it, and through that long term investment they allow the business enterprise to have plant, equipments, land and machinery. Then you have working capital, as he told. He also told that working capital is circulating capital. It goes from one node to another node. Now, working capital in terms of nature is not a long term kind of capital, it is a short term type of capital. Therefore, sources that we have to use in the case of financing working capital have also to be sources which are not of long term nature. These are the sources which are used to bring in money into business for short term purposes. Now, there can be number of sources here. We can get the money from commercial deposits, we can get the money from certificate of deposits, we can get the money through what is known as cash credit. Now, this cash credit is the most popular source of finance throughout our country, in many countries abroad also. To get the short term credit from the banks, which is known as cash credit, we have to have a resolution passed by the board, a line of credit is opened by the bank, and through that line of credit the business is allowed to draw money from time to time. The business cannot exceed the limit that is granted on the resolution which has been passed by the board. To that extent, the money can be drawn. Interestingly, as Swami Sahab has just observed, in the case of long term capital, there are costs. But in the case of short term capital, let us say especially bank credit, the cost is calculated on day to day basis. So, there are a number of sources. I understand that for the working capital, new sources of finance are also coming, and as well as for the long term investment in the business also new sources are coming. But one traditional source which I did not mention is the internal sources of finance. Now, internal sources of finance can come only when an enterprise is in operation for certain given number of years. If it is a young enterprise, then internal sources of funds will not be there. But if you are there for very long, then you get the money through your depreciation, you get the money through retained earnings. So, that is one source. When it comes to working capital financing, we can have even the money through what is known as suppliers credit. We can get the money, machines etc. imported, and those imports are paid say less than 1 year's time. So there can be a number of sources, and we have to make a choice based on our own motives, our requirements, the period for which we need the money, how much we can pay by way of servicing that debt. So several considerations come into picture.
Thank you, sir. Swami sir, can you explain us about the merits and demerits of each source of capital?
Fine. When we talk about the capital, basically there are three very important components of capital. Number one is, already Professor mentioned about equity share capital. Equity shareholders are the real owners of the firm. They are the real owners. Whatever is left in the organization after meeting all the expenditure, all the legitimate expenditure goes to only equity shareholders. Thereafter, we have preference shareholders. By name, the preference shareholders have certain preferential rights. Number one is to get a fixed rate of dividend. Automatically, what happens is their stake is confined only to the tune of dividend that is due for them at the end of the year. Beyond that, they don't have any right in the affairs of the business. That is number one. Number two, when the company goes into liquidation, they will have the preferential right to get back the original investment. That is another merit of the preference shareholders. Thirdly, preference shareholders, they are not entitled for any voting rights. They cannot vote. They cannot participate in the voting. What does it mean? Preference shareholders will not be able to influence the decisions that are taken by the company corporate executives. I mean, the shareholders alone will be the owners. The third component for us available in the market is bond capital, bond or debenture, or we can use another word alternatively, loan capital or ownership capital. When I talk about loan capital, equity shareholders and preference shareholders, though preference shareholders have limited stake, they both are known as shareholders. But specifically when you talk about the real ownership, it is only equity shareholders. But for our sake, when we use the word shareholders, both will come under the banner. Then loan capital is nothing but the amount of funds borrowed from outside. I mean, here you can invite or you can offer bonds or debentures to the public for a limited time. The flexibility we have here is you are going to issue bonds, you are going to pay predefined rate of interest, and depending upon the maturity you are going to clear off. So what happens is, whenever you don't want to incur additional cost, or whenever you are able to earn or mobilize your own resources, you will be able to, or you can pay back the bondholders' money and redeem the debt. So that what happens is you can use your own money within the business. Apart from that, whatever interest you are paying to the bondholders, it is treated like any other expenditure. For instance, you are paying salaries, you are paying advertisement, you are paying rent, you are paying depreciation. All these things are tax exempted expenses. This will come under the same banner, that is tax exempted expenditure. Suppose you are raising bond capital of at the rate of 10 rupees. 10 rupees is the rate of interest. Let us presume that you have accepted to pay 10% interest. So this 10 rupees you are taking before tax. If the effective rate of tax, that is corporate tax, is 50%, your effective rate will be only 5%. That is how you are going to get tax exemption. Hence, whenever you want to design, whenever you want to go for a structuring of the capital of any business firm, you have to keep in mind all these three important components. When we talk about the components of these three elements, which is formally known as capital structure. So, capital structure includes these three important elements, which are naturally long run in nature, long term in nature. Then you do have short term loans. Popularly, we use the word current obligations. When you put together the total of long term loans plus the total of short term loans put together, we will use a word in financial management, financial structure. That's how you have to have a clarity between the capital structure and financial structure. So, in the capital structure, what we are trying to do is we are opting for a mix that yields higher rate of return. As Madam already mentioned, the very objective of any financial management is profit maximization and wealth maximization. In that direction, we have to go for least cost of capital. That is very, very vital, and that is the focus point for today's discussion.
Thank you very much, sir. Mishra sir, can you tell us which source of financing is superior and why?
Thank you very much. That's a very nice question. We can't give answer once for all. We have to take into consideration the nature of the enterprise, the age of the enterprise, the corporate policies, the policies of the government, international competition, the product structure of the enterprise. All these things taken together, they would help us in saying which is the best source. For instance, also let us take the case of age of the enterprise. When a business just starts, around that time we should have grants and we can have equity, because at that point of time business will not have money to pay the interest. So, when you are in gestation construction, you have to see what source you require. When you are in gestation, you have to see what the source you require. When you are in operation, then sources will be different. So, when you are in gestation and construction, you require grants, you require equity capital. When you are in operation, then you are in the position to pay the interest, and at the time we should not depend anymore on grants and equity. They are the point that you should depend more on debt. We have seen, I think, in the case of number of enterprises, they just don't take these factors into consideration, and though they are in good line of operation, they fall sick because the source of capital, as Swami Sahib just told, capitalization has not been done well. Capital structure has not been given the due consideration by the enterprise. We can take a few cases. We can take the case of, let us say, Durgapur Steel Plant. Now, in the case of Durgapur Steel Plant, they started all with debt. They came in production after 15 years. By that time, they had accumulated huge interest, and the result was that Durgapur Steel Plant continued to run into loss for next 25 to 30 years, though it had a very good product mix. On the other hand, you have enterprises which are in the field of consumer goods. In the case of consumer goods enterprises, you see that gestation period is very, very small. So, there is no use of having huge, equity over there. We can take equity, very small equity, we can complete the business, and then we can go in for loan. We start making money at a very early stage, and we can pay it, and with the help of that, the dividend per shareholder, it can be maximized. I will also take a minute on this. You have seen that there are a number of enterprises which are incurring losses. When they incur losses, then we consider as to how to help them in turning around. Then what we do is that we write off their interest and we convert that accumulated interest into debt. Initially it is good, but after some time you will find that these enterprises, they have to pay a huge outgo, has to be made in terms of interest to government, or maybe to those who have put those who have given the debt capital. So we have to be very careful in financing the enterprise, and we have to take several factors into consideration, and there cannot be one policy. This policy will have to undergo a change from time to time depending on the condition of the enterprise, its cash flow, its profitability, its competition.
Very apt, sir, because many students have this query about the right mix of financing, sir. Thank you. Swami sir, can you explain us on what is cost of capital?
Now, when you talk about a cost, I will give you one simple example. Presume that there are two parties. Number one is seller, number two is buyer. When you come to the seller, seller is selling a particular product. I mean, he is trying to fix the selling price. How do we fix the selling price? We take the total cost plus a percentage of profit. So, that selling price includes cost plus percentage of profit. When you look at the angle of buyer, what the buyer is doing? For the buyer, he is paying something and he is acquiring something for which there is outflow of cash from his pocket. For the buyer, it is a cost. Cost is nothing but an expenditure incurred to acquire something. When you look at the seller is calculating not only cost but also adding a portion of profit. So, for him, what is cost? For the seller, the cost is the margin of profit is a cost. For the buyer, the expenditure, the amount paid is the cost. So, as a finance manager, we are working on behalf of the corporate firm. So, for us, what is cost? Cost is nothing but the minimum rate of return to be earned over the investment. That is cost of capital. So, we are using for capital, is it not? So, we call it cost of capital is nothing but the minimum rate of return to be earned over the investment. That is one aspect. The second aspect is, in fact, how do or when do you call return? The return must be after taxes. Any profit must be only after tax. Before tax, it cannot be our revenue or income. Any income has to be considered only after tax. So, it is there are tax applications. If there are no taxes, if the government is not imposing any taxes, that is different. But presume that the government is imposing taxes. Now, there is one more dimension. Let me introduce a new concept. By this time, already you might have got acquainted with the term internal rate of return. As long as the internal rate of return is either equal or more than average aggregate cost of capital, we can approve it, we can accept it. If internal rate of return is lower than the aggregate weighted average cost of capital, then we have to disapprove it. So, what is it we are doing? In a way, indirectly we are going for present value of the money. Internal rate of return is nothing but the rate or the rate of interest that equates the present value of future money with that of present cash outflows. That is internal rate of return. So, what should be the weighted aggregate weight average cost of capital? It must be either equivalent to IRR, otherwise we are not going to accept. Further, you have very clear cut idea about risk and return. You are aware, unless you take high risk, it is not possible to earn high profit, high return. These two are proportionately related, is it not? If the risk increases, profit also increases. When you when you look at any business organization, we have basically two kinds of risks, that is operational risk and financial risk. Let me tell you something about business risk. It is not operational, we can use a word business risk. What is business risk? Business risk is nothing but the operating profit. You must be aware of what is operating profit. The surplus, the revenue which is left after meeting all the operating expenses. So, you have to have clear cut distinction between operating expenditure and non-operating expenditure. The relationship between the operating profit and the changes in the volume of sales will have greater influence, greater effect on the business, that is called business risk. Then you have finance risk. What is finance risk? Here Professor Mistrazi he was talking about the right kind of mix. What should be the right kind of mix? So, what is the right mix? Let me tell you, conclude a single sentence. Wherever the component, the composition of capital structure gives least cost will be the optimal. So, what is our aim? Your aim is to incur least cost. Also, as an expert in financial management, we suggest either cut down the cost or increase the revenue. Both amounts are the same. In that direction, we are trying to work out on cutting down the cost that is likely to be incurred in the capital. Through the capital, we are not referring to ordinary expenditure. We are referring to the cost that is associated with the capital components. When I refer to the financial risk is nothing but the effect of different mixes, on the EPS. EPS is nothing but earnings per share. What do you mean by earnings per share? Whom do we pay EPS? We pay EPS is applicable to only equity shareholders. It is not applicable to preference shareholders, because we pay dividend to the preference shareholders after the tax. After tax, whatever dividend is due to be paid to the preference shareholders, we pay or we subtract from the net profit, and whatever is left will be divided with the number of equity shareholders. That will tell you the EPS. I am not referring to DPS, I am referring to only EPS. So, as a finance manager, what is our job? Our job is to increase the EPS. You see, when we talk about operating risk, I was talking about to reduction of fixed cost or operating cost and the effect of sales. Now, I am talking to the source of financing. So, we can have any source, probably equity, preference, debt. By going for different mixes, how you are going to earn, how you are going to increase the EPS. So, the influence, the effect of EPS by changes in EBIT. EBIT is nothing but earnings before interest and tax. This is called financial risk. We have to strike a balance between operating risk and financial risk while calculating the cost of capital.
Very well said, sir. Mishra sir, can you brief us on what is specific cost?
See, as Professor Swami has just mentioned, there are different components of the cost of capital. There are different components, there are different sources of finance, and each source will have its own cost. For example, we can take the case of equity. Now, equity will have its own cost. The question there is, how can we work out the cost of equity capital? Normally, if I am right, we say KE, cost of equity, and KE will be D over E, dividend by equity. So, the money that you pay by way of dividend for equity to service the equity, that is the cost of the equity. Now, in similar fashion, we can also work out the cost of debt. And there again we will call it KD, cost of debt, and KD will be equivalent to again IOD, the interest cost divided by the debt, we multiply it by 100 and we get the cost of the debt. But as Swami Sahib is telling, in the case of debt, the interest that you pay is a tax deductible expense, and since it is tax deductible, therefore you can work it out. Suppose the cost of debt is 4% and tax rate is let us say 50%, then again you will use a very simple formula. You will say 1 minus T into R. And 1 minus T here, the taxation rate is 50 by 100 and then you multiply it by 2. Then you will see that the real cost of the debt will not be 4%. The real cost of the debt will be 2%. Then we have internal sources of finance. And internal sources of finance, I think we have to be a little clever in calculating the cost. That only I request for Swami, I think, who is the guru in this area to speak.
Yes, sir. Thank you very much, sir. Swami, sir, can you briefly explain the procedure to calculate cost of debt, cost of preference, retained earnings and cost of equity, sir?
Okay. When we talk about the cost of capital, necessarily we have to compute the cost of, first let us go to the loan capital, that is bonds or debentures or any long term loan. The cost of debt will be calculated. There is a simple formula, that is rate of interest into 1 minus T. What is T? 1 minus T. T is nothing but tax rate, whatever it is. If it is 50%, 0.5. If it is 40%, 0.4. If it is 30%, 0.3. So, rate of interest into 1 minus T divided by net proceeds. What do you mean by net proceeds? When we talk about bonds, there is a possibility in the market to sell the bonds either at par value or at premium or at discount. Apart, we have to incur flotation cost. What I want to tell you is flotation cost is nothing but the expenditure associated with release of a paper notification. Whenever you want to issue a prospectus, you are likely to incur on advertisement, that is called flotation cost. So, we need to take the net proceeds of that particular component, that is about loan capital. Then when we come to the preference capital, normally you are aware, for preference shareholders we pay dividend. Whatever dividend you pay, it is explicit. I mean, it is a pre-spelled out, pre-defined one. You are admitting, you are informing, so and so rate of dividend is going to be paid to the preference shareholders. So, at the end of the year, we pay the same rate of dividend. So, the dividend whatever is explicit divided by the net proceeds again. Net proceeds in the sense, even preference shares also can be issued at par, at premium, at discount, and also costs likely to be associated with the releasing the notification. So, we need to take only net proceeds. Then cost of equity. When you look at the cost of equity, what happens is they are the real owners of the business. There is no defined rate of a dividend that is payable to the equity shareholders. In fact, there is no specified rate of dividend payable to the shareholders. Everything depends on the profit. If the firm is able to earn profit, the company, the board will take a decision to declare a certain percentage of dividend. If the company does not earn any profit, there is no question of paying any dividend to the shareholders. So, here what happens? Dividend is totally uncertain. Dividend is totally uncertain. In spite, if you presume that you are going to pay certain amount of dividend to the shareholders, then probably we need to take the dividend that is proposed divided by how we are going to calculate the value of the equity shares. The value of the equity shares will purely depend upon the reserves and surpluses, the P&L account credit balance that is available in the balance sheet. Purely, if there is no profit, there cannot be any appreciation in the equity share capital. So, here what happens is the price of equity share will be determined by the demand and supply, demand and profitability of the firm. So, normally which will reflect the market price of the share, that is called MPS. MPS is nothing but market price of the share. Okay. The dividend proposed divided by MPS plus the equity share capital is either supposed to appreciate or depreciate, both are possible. The value, the firm may pay dividend, the firm may pay consistent dividend, the firm may pay a kind of slowly growth rate, they will have growth rate. So, whatever growth rate you anticipate, you forecast, that will be taken as a yardstick. So, dividend proposed divided by MPS plus growth rate will give you the cost of equity. Now, sir already mentioned about the retained earnings. So, retained earnings is applicable to only those who are in existence, those who are able to generate some reserves and surpluses, P&L account credit balance, this kind of things. So, here it is a kind of free cost, is it not? We need not incur any cost on flotation, we need not pay any return because it belongs to the equity shareholders. So, in this sense, retained earnings is nothing but it is a portion of equity shareholders, it is a part of equity shareholders money. Hence, whatever cost you calculate for equity shareholders will remain valid even for retained earnings. That is how we are going to calculate or we are going to compute cost for different components.
Thank you so much, sir. Mishra sir, can you explain us how do we calculate weighted average cost of capital?
No, Mr. Swami has just explained, he gave you different sources, and what you do is that you calculate the cost of capital of each source, and what you do is that you sum them up, put them together. Yes, the only thing there is that you have to see what is the contribution of each component in the total cost of capital. So, what you do is that you take the cost of capital of that source, multiply that by the share that it has in the total cost of capital, and then you say cost of equity is this much, cost of debt is this much, cost of internal finance is this much, and then put them together, that becomes weighted average cost of capital. Now, this is very, very important. This is very important yardstick, very important indicator. Am I right, person?
Yeah.
Because that is known as hurdle rate, and hurdle rate is the rate which is the minimum rate that you have to earn to stay in the business. If you are not able to earn that hurdle rate, then you have to go out of the business. And therefore, as Professor Swami and I think yourself you have told, we have to rearrange the cost of capital in such a way that we are able to strike that hurdle rate. But again, I would request Professor Swami to throw more light on that.
No, you are right.
Wonderful, sir.
Perfectly, that is right. What Professor said is correct. It's only proportion of different components we are computing. Proportion to the total multiplied with the specific cost will give you weighted average cost. When you total it, we call it weighted average cost.
Excellent, sir. We have learnt how to calculate the hurdle rate. Swami sir, how the weighted average cost of capital which we have just learnt helps the manager in taking decisions?
As you are aware, a manager is there to take decisions, but most of the managers are ignoring this area and concentrating or focusing on waste things. Every manager has to be he must be careful enough to plan the composition of the capital in such a way where the weighted average cost is low. Already I have hinted, it is not a cost. When you ask me what is capital cost, what is the cost of the capital, it is not cost of the capital. What is that? It is the minimum rate of return to be earned over the investment. For me, it is minimum rate to be earned over the investment. It is not cost for me. I am an entrepreneur. I have to earn the desired rate of return over the investment. My desired rate of return over the investment is very long back decided. Much before starting the organization enterprise, my rate has been already calculated, already decided, it has been already prefixed. My job is whether I am in the same direction, whether I am in the same path to reach the pre-designed rate of return or not. For that purpose, I need to calculate the weighted average cost. Once, if I am able to calculate the weighted average cost, I will be able to tell you how much money to be earned over the investment to realize the desired rate of interest. That will give you weighted average cost. I will give you one simple example. When you talk about cost volume profit, it is a break even point, is it not? So, break even point will tell you what should be the sales if you wanted to earn so much of profit, is it not? It is a tool, it is a technique that will give you what should be the sales to earn the desired profit. In the same lines, weighted average cost will give you what should be the cost of, what should be the weighted average cost of capital to arrive, okay, how much profit you need to earn, how much profit you need to earn. So, here we are not referring to the profit before tax, we are referring to the profit after tax. If you are careful, we are paying dividend to the preference shareholders after tax, we are paying dividend to the equity shareholders after tax, we are paying or we are allowing, we are admitting interest and debentures before tax. You are allowing interest before tax. So, what is that? You are getting tax advantage of 50%. Automatically, everything you are computing after tax. In this sense, weighted average cost of capital will tell you how much amount to be generated after tax to realize the desired rate of return apart. This is financing decision. When you look at the financial management functions, you have three important basic functions. One is capital budgeting, that is investment appraisal. Number two is financing decision. So, in the financing decision, what are we doing? We are trying to list out different components of capital, we are trying to compute the cost of different components, and we are trying to calculate the lowest cost that will give the proper mix. Whatever mix that gives the lowest cost alone will be taken for the purpose of capital structure. Otherwise, we don't take it. We don't require any financial managers. We need finance managers to calculate all these things. It is not simply sitting on a chair and issuing orders. It's nothing but a kind of decision making process. All the time, as a finance manager, we have to focus on reducing the cost. I mean, capital has cost. Whether it is your money or others' money, capital has cost. So, if you don't put the capital into use, are you going to earn any return over the investment? Definitely you are not going to earn anything. So, all the time we have to look at the composition of different components and arrive to the lowest cost. That is the decision making part.
Wonderful, sir. There was a very good relationship between cost of capital and the other aspects of financial management. Mishra sir, do the corporates and business enterprises follow the same kind of pattern which we are discussing, or is there any gap between the theory and practice?
Very, very good question. and we can take the cue from Professor Swami. Theory and practice should go hand in hand together. But unfortunately, it doesn't happen. I am reminded of a case where Swami Sahib was telling that finance director was sitting in chair, but was not understanding the implication of the decision which would be there on the enterprise. And he also mentioned, I think we must take, I think, a pick from what he spoke. Financial policies are important. Sometimes what happens is that workers are working very hard. Your site selection is good, location is good, your product structure is good, market structure is good, but you have made a wrong financial decision. And this one decision can finish and kill the enterprise forever. Now I give you a case, Swami Sahib. What was happening was that there was CMD of a company, and director of finance would come to him and say, "Sir, this time we raised the money by way of equity. Sir, we need more money. Shall we? We have to raise money. Then how can we go?" Then director of finance, the chairman will ask, "So last year you had raised the money by way of equity. Why can't you raise the money by way of debt?" Then this man, our director of finance will say, "Sir, last year our debt equity ratio was 3:1. Year before last it was 4:1. What should I make? Should I make it 1:1 or 5:1? Then, like ticking, CMD told, "We can make it 5:1. Without understanding what is the meaning of 5:1, what is the meaning of 1:1, when equity should come, when debt should come. They didn't understand what debt means, what equity means. And it's not an apologetic decision that you make a decision. Is there no? That apologetic decision is going to kill the enterprise. And therefore, we have to be very careful. And I think one thing I think we may have to agree that always, as Swami Sahib told, you have to make the decision in such a way that dividend per share or equity, dividend per equity share should be maximum. One thing, we should be profitable and we should also be liquid. These things we have to keep in mind, and keeping that in mind, then we should design the capital structure. And he also talked about EBIT-EPS analysis. All these are very, very important consideration, and there must be full debate and discussion. And director of finance must do, I think, sufficient, adequate work, and should make the presentation and should present the picture to the board and to the enterprise. But unfortunately, it doesn't happen. And I'll say that in many cases, when we talk of sickness, 20 to 30% sickness cases are there because of bad capital structure decision. There may be another 20 to 30 because of technology or site location, but mostly they are there because our capital structure decision was not right. For instance, as Swami Sahib was telling, he talked of what is known as working capital. Now, number of enterprises, they have taken working capital from chit funds. Now, when you take money from chit funds, then whenever there is a problem there, they will like to take away the money. When they take away the money, then what happens? You are left with no working capital. As you told, working capital is circulating capital. There is nothing to circulate. And this has happened in the case of many entrepreneurs who are from the field of sciences and technology. In our own state, in our AP, they came from labs. They came from labs. They set up enterprises, but they had no money. They went to chit funds. And chit funds wanted to get back the money. The problem tomorrow was that how to run the business. And the business, it became a failure. Therefore, I think sufficient mind, I think, has to go into it. And I think each word that he spoke, I think is very, very important.
Excellently put it, sir. So, viewers, I think you must be understanding how important it is to design a capital structure. We are really enjoying the enlightenment of knowledge. Swami sir, can we ask you, what factors do we need to keep in mind while designing capital structure?
Already we have discussed thoroughly what are the different components, what is the specific cost, what is the weighted average cost. After going all these things, as a manager, we are not here to take hunch decisions, we are not here to take hasty decision. Whatever decision we are going to take must be effective, and it must contribute positively to the institution. You take any manager, managers are there to take their own decision. They are not there to consult their bosses. We have to give up this. Don't consult your boss. Your boss is weaker than you. You are an expert in the area concerned. Suppose you are a marketing manager, you are a finance manager, you are accounts manager, you are production manager. You know you are better judge. In view of this, I will suggest certain very important things to be kept in mind while designing the capital structure. Number one, I will come to the cost. The cost, whatever mix, whatever source, whatever combination you take, the cost must be least and the EPS must be high. Low cost, high return. That must be the principle before designing the capital structure. Number two, control, which is very important for any organization. Suppose you have 10 shareholders in an organization, the controlling will be different. You have 100 shareholders, the controlling will totally differ. You have 1000 shareholders in a particular organization. What is happening as the number of shareholders increases, the control gets declined or decreased. So, dilution is taking place. As a manager, we are not here to wait for a discussion, debate and take decision. By the time you take decision in the committee, by the time whatever damage, whatever loss has to be caused, that will be damaged. So, here enabling the management to take a quicker decision, controlling is also to be taken into account. Normally, the tendency of any human being is not to dilute the control. Suppose we three are the shareholders in a particular organization. We don't wish to join fourth member as a shareholder. We don't wish to join another 30 people as a shareholders. What happens? Because the control gets diluted. So, to the extent possible, you have to retain control within the few people. Why? In order to take spot decision. Management is decision making, nothing more than that. It is a decision making. You are not here to drag on, you are not here to look at others. Then liquidity, sir already mentioned. What is liquidity? In case of any uncertainty, you must be able to convert the whole thing into cash. Liquidity, that also must be there. That is called liquidity. If you are not liquid, definitely you are going to face problems. Last but not least, flexibility. What is flexibility? Suppose you are the finance manager of a very big organization. As sir mentioned, you are going on issuing equity shareholders without thinking, without paying attention to the implications of the equity shareholders. If you issue equity shareholders, they are long permanent, they are the permanent owners. Can you send them back? You cannot send them back. They are bound to continue till the company goes into liquidation. So, there is no flexibility, we are missing flexibility. Alternatively, we can select preference share capital. Preference shareholders have limited stake. They are entitled only for dividend at the end of every year, that is fixed dividend, and only claim when the company goes into liquidation. That too, you can fix the time, so that you will have the flexibility to redeem them back. You can send them out. In the same sense, bonds also can be issued for a limited period. So, that is flexibility. We have to have flexibility. If you lack flexibility, what kind of decision you are going to take? So, that is why finance manager, finance director, all the time he must be cautious what is that he is doing and what are the implications of financial management.
Thank you very much, sir. Mishra sir, can you briefly explain the cost of capital practices across the globe?
See, I think many things have come, but there are 2-3 things. One is trading on equity. We have too less of debt and too less of equity and too much of debt. That has a very great danger, because there are corporate traders. they don't do anything. They don't think of the enterprise, they don't think of land, they don't think of, fulfilling processes. They just sit in the corner. When the enterprise is highly profitable, they just come forward, they buy that small equity, and they take the control. So the point that Professor Swami made is a very, very important point. You have to design capital structure in such a way that corporate traders who have not made any contribution, they just pounce on the business and then take it away from your hand. So that's very important. Number two, which is very important today, world over today, people are going by different geographies. Let's say India is there, business is in India, or Indian has set up a business, but it has branches all over the world. Then what is happening is that they are getting capital from all over the world. They don't depend only on BSE, NSE, or our Hyderabad Stock Exchange. No, it is a global idea, and therefore money should come from all those who have any faith in the business. And therefore, I think what is important today is that for a good capital structure, we must look outside. We must look outward. We should not be limited to our own geography. But as I told you, I think world over, I think each day it's not only working capital management where you have to make decision on day-to-day basis, as Swami Sahib was telling. In the case of capital structure also, you have to make decision on each moment you have to make. This is the global practice.
Excellent, sir. And I think, friends, we had a very lively discussion. It did not only cover the fundamental concepts of the area, but it also gave us an exposure on the practical side in terms of the applications that cost of capital has in the industry. It bridged the gap of theory and practice. Viewers, I am sure you must have enriched your knowledge through these discussions, which were truly value additive. I'm sure I'm carrying certain points home, and probably you also have enriched your knowledge very much in this area. So on your behalf, I thank our professors for enlightening us on our knowledge in this area. Thank you so much, sir. Thank you so much, sir.
Thank you.
ఇప్పుడు చెప్పాం కదా అని సాయంత్రం ఏపీ ఆన్లైన్ సెంటర్కి వెళ్ళకండి దయచేసి. నోటిఫికేషన్ రావాలి. అది రావడానికి ఒక 4-5 రోజులు, వారం రోజులు పడుతుంది. నోటిఫికేషన్ వచ్చినప్పుడు తేదీ నుంచి ఒక చివరి గడువు ఉంటుంది. ఆ గడువు లోపల ఎప్పుడైనా సరే దరఖాస్తు పెట్టండి. కానీ గడువు ఉంది కదా అని కాలయాపన చేయకుండా నోటిఫికేషన్ రాగానే దరఖాస్తు పెట్టడం అనేది మంచి విద్యార్థుల లక్షణం. ఆ విధంగా చేస్తారని ఆశిస్తూ ఉన్నాం. ఈ కార్యక్రమంలో పాల్గొని మనకు అనేక రకాలైనటువంటి సందేహాలు నివృత్తి చేసినటువంటి సంతోష్ రెడ్డి గారికి, అమూల్యమైన సలహాలు సూచనలు ఇచ్చినటువంటి బనోత్లాల్ గారికి యూనివర్సిటీ పక్షాన అట్లాగే విద్యార్థులందరి పక్షాన ధన్యవాదాలు అర్పిస్తున్నాను. ధన్యవాదాలు.